Welcome to part three of my four-part series on doing a discounted cash flow analysis for a company. And this video is going to focus on forecasting cash flow. Clearly that's important because that's what we're going to discount back to get a valuation for a company. And what we're really going to discount back is the concept called free cash flow. Free cash flow is the cash flow that a company generates that is available to be distributed to anyone who financed the firm. So that includes both equity holders and creditors. Creditors would be bondholders, banks, and whatnot. So first we got to figure out what's the total value of the company, and then we'll, at the end, figure out how to parse that out between the equity holders and the bondholders. So the free cash flow definition that I'm going to use is simply your after-tax operating income. You add back in your non-cash expenses, and then you subtract out the net investments in the firm. So, to put it more formally, we're going to take earnings before interest and taxes, or EBIT. That's your operating incomes. You're going to take the after-tax operating income here, so 1 minus the tax rate. You're going to add back in depreciation and amortization. Depreciation and amortization are what we call non-cash expenses. So yes, they do lower earnings, so they lower this E number, so they've been taken out of this E number already. However, it doesn't cause you to write a check, right? They're almost like fictional, in a way, expenses where you just lower your income, but it doesn't really, cause any kind of cash outflow. So we're going to add that back in order to calculate the cash flow generation. Then we're going to add back in. Actually, we're going to subtract. My apologies. We're going to subtract any increase in working capital. So working capital is an investment in the firm. So that's, buying things like inventory or growing your accounts receivable. It's your short-term assets. We're going to strip out cash. We're not going to include the cash, which is, of course, also a short-term asset, but we're going to do it net of cash because cash is ultimately what we're trying to forecast here. And then we are going to take out capital expenditures. So that's, investments in property, plant, and equipment in the firm. So I'm going to show you how to do all this. And the first thing, of course, is we've got to forecast out earnings. We've got to forecast balance sheet items. So we're going to forecast out an income statement. That's our first step. And I'm going to use Walmart here as my example. So Walmart, I've downloaded their 10K. The most recent 10K that they issued for me at this time period in November 2021. The most recent 10K came out in March of 2021. So that shows you the year ending January 31st. So this is like 2020 income. This is 2019 income. This is really, for all intents and purposes, 2018 income for Walmart. So we got 3 years there. What I want to do is forecast out next year's income, which would be basically 2021 income. That will be January 31st, 2022, 10K when that comes out. But so the first thing I'd like to do to forecast out an income statement is I want to create a common size income statement. That's my first thing that I'm going to do because that's going to help me forecast out my items. And you'll see what I mean by that as we go through this. So what's a common size income statement? That's where I take all of these items here basically and divide them by total revenue. Okay, so everything is divided by total revenue. So in other words, if I just click on that cell, you see it's B6 divided by B6. So clearly total revenue is 100% of total revenue. However, cost of sales for 2315 is 75% of 559. So you can see that this is B8 divided by B6. So that's their, cost of sales margin, if you want to think about it that way, 75%. Then you got 20% on SG&A, or 21%, and then on downward. So the most important thing to do when you're forecasting out income statements is to forecast next year's sales. What's next year's total revenue going to be? Because once I figure that number out, then what I can do is hold a lot of these ratios constant and then project out next year's income relatively quickly. So, for this, I could look at historical trends. So last year I calculated this already, or 2 years ago, Walmart grew their revenue by 1.86%. So you can see it's C6. It's this number divided by that number minus 1. In 2020 fiscal year, they grew their revenue by 6.72%. So, quite a bit of difference. Of course, 2020 was the first year of the pandemic, I guess. and that may have had some impact on Walmart. Walmart did stay open. A lot of other stores stayed closed, so perhaps they grabbed some market share during the year. Who knows? So, the question is, what's next year's revenue going to be? What's in the year after that and the year after that? So this you might actually in the real world spend weeks figuring out that number. It's a really important number to get right. So you would look at analyst reports, you would read Walmart's guidance, you would read anything you can to get that number right. For now, just for illustration purposes, I'm just going to assume a 5% number. But again, that is a number that you would want to think long and hard about before you went ahead and did this analysis. So what I did here is I got 587. So I just took this number here, 559, and I multiply it by 1 plus K1, and that's my 5% number. Always you want to keep your assumptions like 5% growth on the outside of your model, so you can later change that number, and it will change all of your other numbers. It allows you to tweak the model and see how things respond. So I've got 587 now, so if I want to get cost of sales, now all I'm going to do is take this 75.2% number, and I'm going to multiply that by 587. So you can see that here. That's F8 times H6. And that's what I've also done here for operating for SG&A. So I'm keeping everything constant in terms of percentages relative to sales. Now, you may again have more information. Walmart may be in a cost-cutting initiative, for example, or maybe a cost increasing initiative, who knows, where this ratio, you may want to use a different ratio for next year based on your analysis. I'm showing you more of the science, but there's a lot of art behind the scenes that you're going to want to bring to the table to get a better forecast. But this is really just illustrating what I would do, absent any additional information. So now for operating income, it's just 587 minus these two numbers is 23,675. So that's actually the EBIT number that I'm going to use, earnings before interest and taxes. Now, here comes the interest, and there comes the taxes thereafter. Interest, they pay interest on a few items, bonds, debt, bank loans, who knows what else they got in here in this debt number here. They got finance and capital lease, interest income. So they actually make some money. When they have cash, they'll put it in short-term securities like treasury bonds and treasury bills, or could even be commercial paper. And so they'll make income here, which is an offset to the debt that they're going to be, to the interest they're going to be paying on their debt. That's why it's expressed as a negative number. It's kind of ironic. Their income here is expressed as a negative number, and their costs are expressed as a positive number. So when I add all this up, for last year it's 2194. I'm just going to hold that number constant. This is one of those ratios that I've got it. That's why I've got it kind of boxed in here, because I'm doing something a little different. But I'm not holding that as a ratio. Now, you could go through their 10K, and they may tell you that they're issuing a lot of debt this year, and so you may want to adjust this upwards, or they may tell you they're going to not issue any debt, and so you might want to leave it kind of similar. For now, I'm just leaving it constant. So now I get income before income taxes, so that's just subtracting out this 2194 from 23,675. I get this, and then I need my income taxes. What am I going to pay in taxes? Well, interestingly enough, what I can do is use these ratios here. So last year, I think if I do this ratio here, it's some number like 33%. If I take 58 divided by 20, 50, 64, I believe that's around 33%. I believe this number is a much lower number. It might be something, call it around 24, 25%. This number here. So their effective tax rate has changed based on not a different change in tax laws during these years, because the tax laws didn't change during this time period, but it could be they had deferred income taxes that they were paying, who knows what. I'm using a number of 28%. I also happen to know that the U.S. corporate income tax as of this time is 21%. However, there are also other taxes that they're going to be paying, state and local or whatever else other taxes they might be paying. And also, they may have some deferred taxes they need to pay. So I'm going to put it at 28. But again, this might be a number you spend some time trying to really think about and get right. So that gives me this number here. When I take 21,481 divided by minus 6,015, I get consolidated net income. I figure out what the net income is attributable to their non-controlling interests. And so non-controlling interests last year was 196. So I took that ratio, 196 to 13,706. So that's what this 1.4. I put this in blue here, but it's 1.4. The 33% is their 33% tax rate. Yeah, this 1.4 is the ratio here. I put these in blue because they're not common size numbers, right? These are not ratioed relative to sales. They're ratioed to something different. So just to set them apart and make a mental note. So I'm using this 1.4% number. So I'm going to go ahead and multiply 15,467 times 1.4%, and that's where I get $221. I probably should have cleared out that decimal place there, but you get the picture. Now I take this and I get 15,245 for consolidated net income attributable to Walmart. So that's how I do the income statement. Some of this is going to be important for the for cash flow forecast. Okay, so just bear with me. I'm going to do the balance sheet next. Again, I've got 2021, I've got 2020. Really, I think of this as the 2020 year, and I think of this as the 2019 year, and I'm going to forecast the 2021 year. Now, I don't do a common size balance sheet. A common size balance sheet would be if I divide everything by total assets. That's how you do a common size balance sheet. However, I am doing it very similar to last time, and then I'm taking everything relative to revenue, to total revenue. So I am doing it just like I did the income statement in many ways. So if you look over here, I've got B4, which is this number here, receivables, divided by the income statement B6. So let's go back over here and remind myself what income statement B6 is. And again, that's my total revenues number. Okay, so you see that. And so really I've done that here. I've kind of just done all the ratios here relative to last year's revenue. And I'm going to hold those constant. Okay, so I've got next year's revenue of 587,109. I multiply that by 1.17 and I get 6842. All right, so you see that there. The reason I've got cash in blue, by the way, is cash is the last thing I'm going to forecast when I forecast the balance sheet. And why is that? Well, cash is going to be the plug that makes assets, you can see assets at 252 here in 2020 equal liabilities plus equity. Assets must equal liabilities plus equity. So in order to enforce that on my forecast, I'm going to forecast that last. That's going to be the last thing that I put the plug in for. Okay, so just assume that number doesn't exist right away when you're doing this. And so you do inventories, you do prepaid expenses, all constant to revenue using this percentage. PP&E is a little different. I should probably blew this out because this one's a little different as well. Let me go ahead and do that. Let me make a note here. This one's a little different. Property, plant, and equipment is simply going to equal, it's going to equal this property, plant, and equipment plus CapEx minus depreciation. Okay, so when I look at this, so I wonder if I have got this right, but let me just double check this. It's B8, property, plant, and equipment. I've got this as a minus sign. I need to change this to a plus CapEx. Plus CapEx. So it's DCF analysis F11. We'll check out that in a second. And minus CapEx. Okay, plus CapEx minus depreciation. I need to change that number. My apologies. So let's just check that out. I've got plus CapEx. This is my number here. So it's F11. And I'll show you how I get the CapEx number in a little bit. We're going to have to look at this in a little bit. But this is a separate spreadsheet that I created to calculate my cash flow. So we'll get to this statement last. But here's my CapEx and here's my depreciation number, which I forecast later. So I just want you to know that. So I had that in there wrong, but now I've made that adjustment. It's plus CapEx minus depreciation. That's going to be next year's property, plant, and equipment number. Those are important numbers to know. Everything else I ratio. Goodwill I kept constant. Goodwill is something that's often not amortized anymore, so it can stay flat. Now I do notice that it did go down here between those 2 years, so I might want to dig into that a little bit more. Is there something in the goodwill that they are amortizing and writing off? But I'm going to hold that constant, and everything else is ratioed there. So at this point I wouldn't have total assets. Just remember that number would be blank. I wouldn't even really know what total current assets are, right? Because I don't know my cash number yet. All right, so but now I could go down and do liabilities. Now, short-term borrowings, I need to blue this one out because this would be something that I would hold constant as well. Now, they may tell you what they're going to issue in debt, But if they don't, a lot of times you just hold borrowings or debt constant. A lot of companies are issuing debt these days, so given interest rates are low, that might be something you do take a look at. Long-term debt, I'm keeping that constant as well. These are all ratioed relative to sales. So again, I'm using these 8.79, these 6.79 numbers and multiplying it times next year's sales. And so, this is ratioed, that's ratioed. So total current liabilities, that's just going to be the summation of all this. So I'll have that number. Long-term debt, I'm going to hold constant. These are all going to be ratioed. And so I can do all my liabilities. So those are all in there. And then for equity, just finishing it off. Common stock, I would assume they're not going to issue any more common stock. So I keep that in capital in excess of par value. I keep all that constant. Now they may tell you they plan to buy back stock or issues. A lot of companies these days are buying back stock. So, usually you're going to have kind of a treasury stock line in here and boost that a little bit. My retained earnings, this is kind of a little bit like the property, plant, and equipment line where I'm going to take last year's retained earnings. I'm going to add net income. Well, where do I get net income? Hey, I just forecasted that, right? That's over here. That's down here. Net income attributable to Walmart. Okay. So let's go back over here to the balance sheet. So, you can see that I've taken last year's retained earnings plus the income statement, the income that I just forecasted, minus dividends. Okay. Now the reason I've got that as a plus is because I think I'm expressing dividends as a negative number. So let's take a look at the cash flow statement. It's looks like it's I-30, or that's L-30. It could be L or I-30, but it's a 30 number. So it's right here. So I'm projecting minus, in other words, a cash outflow for dividends of 6901. I'll show you how I get that number in a second as well. So a lot of things that have to be calculated along the way here. And so you keep on going down the line. I'm holding that constant. I sum that up. I take into account my non-controlling interests here of my forecast that I did on the last page of 221 to boost this number to 6827. And so then I get total equity. I sum all that up. Total liabilities plus equity, 267,083. Once I have total liabilities and equity of 267,083, I know that I can put that number in there. It's 267,083. So I'm just actually linking F36 here, which is that number at the bottom. And then therefore the cash will just be the number that makes it all equal. And so I figured that number out on the side. I typed it in. It's 27,394. Okay, so that's my cash. It looks like my cash is going to go up about 10,000, maybe a little bit less for next year. So, but that's not my cash flow forecast that I need for free cash flow. So, let's just look at the statement of cash flows. I'm not going to forecast that out. I don't really need to, but there's a couple of line items I need. I need to know what my depreciation and amortization number is going to be. So what I do is I calculate last year's amount relative to, just the growth. Okay, so what I'm doing here is I'm just showing the growth in depreciation. Now, and I'm just assuming it grows at 1.5% per year. Now that's a little bit, that may not be exactly what you want to do. What you could do is look at how much they're depreciating every year relative to their property, plant, and equipment. What's that ratio? What's 11,152 divided by the beginning of the year property, plant, and equipment? What's that ratio? And assume that ratio stays constant and use that for your forecast for depreciation. That's certainly one way you can do it. I'm just going to assume that it's going to just grow because it's been growing kind of constantly by 1.5%. So I'm just assuming it's going to grow by that number. Okay, so net cash provided by operating activities. This is another thing. This is going to be my reality check. And so what I'm going to do here is simply take my cash flow provided by operating activities. Sorry, this is my free cash flow forecast. I'll take this number and I'm going to subtract out my cash flow from investing activities. Because free cash flow is a good proxy for that is net cash flow provided by operating activities minus CapEx. And so it's kind of been all over the place. It's gone from 3,700 to 16,000 to 26,000. and these are all expressed in millions. But so, you know, it is it's all over the place. It's not steady. So I'm guessing my forecast for cash should probably be somewhere in the ballpark here. So just something to keep in mind. My CapEx as a percentage of revenue, this is another thing. If I want to forecast next year's CapEx, I can take next net cash used in investing activity. That's my CapEx basically. And I'm going to divide it by sales, just like I did with all the other ratios, right? I just take CapEx relative to sales. So I'm going to use that 1.8% number, and I'm going to multiply that times next year's sales to get my next year's CapEx forecast. So you can see how I'm going to get my depreciation forecast. I'm going to grow this by 1.5%, grow it by 1.5%, and I'm going to ratio my CapEx to next year's sales. And that's how I'm going to get the CapEx and the depreciation that I'm going to use in my cash flow forecast. One other thing that I wanted to point out, my dividend payout ratio. So this is for remember my retained earnings number here. And that was on my balance sheet. My retained earnings number was down here somewhere. And so I did plus net income minus dividend. Well, the way I'm going to forecast dividends for this is simply take this payout ratio, this 45%, and I'm going to multiply it by next year's income. So you can see that right here. I take this 48%, 45% number here, and I'm going to multiply it by H21. So income statement H21, that is right here. Okay, so that's how, and does it make sense? 6901, what's been their history of paying dividends? Well, they paid 6,100, they paid 6,048, they paid 6,116. They've been constant around 6,000. That's another thing I could do. I could just assume, hey, maybe Walmart's got a policy where they only pay like $6,000 before you multiply by a million. So 6,000 in dividends. Maybe that's their policy, just to keep that constant. But I'm going to assume they grow it with income. It makes sense that they would grow it with income. So I'm going to raise it to 6901. Okay, a lot of stuff here. So you're like, what does this have to do with cash flow forecasting? Well, here it is. We can use all this stuff now to forecast. And what you would really want to do when I want to forecast cash in 2021, I would really, if I'm doing a full DCF analysis, I would want to do this, for at least 5 years. I'd want to forecast out for 2022, 2023, 2020, on and onward. So you might have to forecast out your income statement a number of years and your balance sheet a number of years, and to get those numbers. So I grab a lot of this stuff is linked. So I grab my earnings before interest and taxes from H10. So income statement H10. Let's just check what that number is. H10, that is this number. It's operating income, earnings before interest and taxes. By the way, not every company will put operating income on their income statement. They won't calculate it for you. Some won't, some will. If they don't, well, then you just know that it's total revenues really minus cost of sales, cost of goods sold minus SG&A. That's your operating income. And so I'm taking this number here as my EBIT. Okay, let's go back over here to the DCF analysis at the bottom. So that's my number. I'm assuming a tax rate of 28%. So when I do EBIT minus 1 minus the tax rate, times 1 minus the tax rate, I just go 1 minus F6, 28%, and it's 17,000. Now I'm going to add back in my depreciation and amortization. Okay, so my depreciation, if you remember, I'm going to grow it by 1.5%. So that's what this item refers to. It's cash flow statement E6. Let's just go back over there. Cash flow statement E6. That's right here. No. It's right here. Cash flow statement E6. It's 1.5%. That's my assumption. Okay, that's my assumption. And let's go back over here. So it's cash flow statement E6. E6 is right here, and it's also B6 times 1 plus E6. So let's go back over here. It's a B6. So it's last year's depreciation times 1 plus 1.015. So I'm just growing this number by 1.5%. That's all I'm doing. Again, that's one way to do it. There are other ways to calculate depreciation. Holding a fixed ratio relative to property, plant, and equipment is not a bad way to do it as well. Here I'm going to subtract out my change in net working capital. Well, how do I get my change in net working capital? Well, all my net working capital is my increase in current assets minus my increase in current liabilities. So my increase in current assets, you can see it's F4 to F6, the sum of that, minus B4 to B6. So let's just double check that. It's balance sheet, F4 to F6. Let's just make sure we've done this right. So we've done a couple other mistakes today, so I want to make sure I do this right. B4 or F4 to F6, it's receivables, inventories, prepaid expenses. It's all my current assets that aren't cash. Or if you see marketable securities, you'd want to strip that out as well, or short-term investments. And so it's these numbers minus these numbers here, the sum of these three numbers. Okay? And so that's the increase in current assets. The increase in current liabilities, F15 to F18, B15 to B18. Let's just check that out. Okay. F15, so short-term excuse me. F15 to F18, B15 to B15 to 18. So it's short-term borrowings, accounts payable, accrued liabilities, and accrued income taxes. Now, short-term borrowings don't change at all, so that really doesn't factor in. So so I left that in, but you've got accounts payable, accrued liabilities, and accrued income taxes. So those are the three items really that are driving this. So when I go over here, I notice that my current liabilities increase more than my current assets. That's not always going to be the case for a lot of firms, but it is here for Walmart. And so it's a negative number. So I'm really subtracting a negative number here. So it's kind of like a disinvestment in their firm. They're actually increasing their liabilities more than their assets. And so that's actually a source of cash, if you want to think about it, because I'm taking this number, I'm adding in depreciation, and I'm subtracting a negative number. So that's basically like adding in 751. The last thing I want to do is subtract out CapEx. So CapEx, I take the negative of a number that I calculate over here. It's the cash flow statement F25 times the income statement H6. So cash flow statement F25 is right here. Okay, so F25, this was just, all I did, remember here, is I took this number and I held it constant to sales. So it's just the ratio. It's like the common size to sales number. It's minus 1.8%. It's a negative number, means it's a cash outflow, means, in other words, it's an actual purchase of CapEx that they did here. And I think I did income statement H6, right? And so that was this number. Let's see. Let's just go back over here. Yeah, so it's that 1 point. So let's go back over. It's this 1.8%, which is relative to B6. So it's B25 divided by income statement B6. B6 is, again, last year's revenue. So it's the ratio to last year's revenue, just like everything else. And then for CapEx, we're going to multiply ultimately by next year's revenue. So we take last year's ratio times next year's revenue. Income statement H6. Income statement H6. So next year's revenue right here. Okay. So that is my CapEx estimate. So now for my free cash flow number, I'm going to take this number plus this number minus this number, which is really a plus, minus that number. Okay, you can see that all right here, and that gives me $18,542,000 for Walmart. Now, you're like, wait a second. I recall that the balance sheet that the cash only increased by 10. So you're telling me they generated 18. Well, here's the difference. They also paid some dividends, right? So they paid about almost $7 billion in dividends. So if I subtract that out, now we're down to about $11 billion. And so that's pretty close to the increase in the balance sheet here. That's pretty close. So that's nice to know. The other thing is there's going to be some minor differences because I'm subtracting out taxes here on EBIT income, not on total income. So when you actually pay taxes, the actual tax that you actually physically write out, that's going to be deducted from earnings after interest, not before interest. And secondly, there are maybe some long-term assets or long-term liabilities that they might grow a little bit that will be a net investment or a net subtraction to the cash. And I'm not accounting for that when I do this equation here. This is the classic equation that we're looking at. Really, increases in working capital is the net short-term investments in your firm. And so CapEx is really the proxy for the long-term investments, which is the property, plant, and equipment. But there may be some other items there that are influencing it. But overall, there are different methods to calculate free cash flow. This one's getting me pretty close to what I want, and I think it's a good number here. So again, it's good to reasoning, going back, making sure the number you calculated, this 18 billion, is about right. It seems like it's a pretty good number to me. It's about right. Now, if I wanted to go ahead and forecast out the next 5 years, a couple things I could do. An investment banker is going to project out every single year for the next 5 years. They're just going to go through the balance sheet, income statement. And once you do it one time, it's pretty easy to kind of drag a lot of items over and keep it going and make those calculations. So they could do that pretty easily, or you could do that pretty easily. The second thing you could do is maybe you say, this is a pretty steady state that Walmart's at here. So I've calculated that this free cash flow is actually 3.16% of next year's sales. So what I could do is hold that number constant. I could say, well, maybe they'll always generate 3.16% free cash flow relative to sales. I could just hold that number constant, project out sales for the next 5 years, and then just drag it across, nice and easy. So that would be a very quick way to do it for a quick DCF analysis. However, if a firm like Walmart, that's not a bad thing to do necessarily, because they kind of are a steady state firm. But if you were looking at a company like Tesla, or even in Ford in 2021, it's made a lot of changes in the auto industry this year, where they might have quite a bit of growth going forward. If it's a high growth firm and things are going to change and some of these ratios are going to change over time, you might need to project out those detailed years going on forward, because you just might get some different ratios and different numbers to use. So, but that's a quick overview of how to calculate free cash flow. Once you get that back, we'll take it to the final step in video 4, how to discount all that back and come up with a valuation for a firm. So if you like this video, please give it a thumbs up, or subscribe to my channel, because my channel is all about making finance fun for students. Thank you.